Picture a business owner who decides to categorize his luxury family vacation, daily high-end dining, and expensive wardrobe under the banner of business marketing. He operates under the illusion that every dollar spent can simply disappear into a tax write-off. 2 years go by. Then the IRS audits his returns. The fantasy ends abruptly. The agency rejects over $60,000 in improper deductions. They assess back taxes, stack on interest, and apply severe fraud penalties that bring his company to the brink of bankruptcy. His fatal flaw was a complete misunderstanding of how the government actually categorizes legal business expenses. Claiming personal lifestyle choices as business write-offs creates a massive vulnerability that will rapidly destroy the company from the inside out. Welcome to the G-Code. Serving 11 years in the United States Marine Corps teaches you a lot about discipline and oversight. When you apply that military mindset to business finance, you realize that treating improper deductions as a casual oversight constitutes tactical negligence. Approaching tax strategy recklessly leaves your financial flank completely exposed, giving the government an open invitation to dismantle everything you have built. Whether in combat or in commerce, rules of engagement exist for your protection, not your punishment. To survive an audit, you must understand a very specific phrase: ordinary and necessary expenses. This document establishes the strict legal reality. Under Internal Revenue Code Section 162A, the IRS dictates exactly what can and cannot be deducted. The first pillar is that the expense must be ordinary, meaning it is a common and accepted cost in your business. A high-end designer wardrobe, for example, immediately fails this test for a standard consulting firm because it is a personal cost, not a commonly required uniform. The second pillar requires the expense to be necessary. The cost must be directly helpful and appropriate for your actual daily business operations. These are not multiple-choice options. Failing just one of these tests completely invalidates the deduction. Without both pillars standing firm, a claimed deduction is legally indefensible. It stops being a strategy and becomes tax fraud. Knowing the definitions provides a theoretical defense. Internal Revenue Code Section 274 acts as the physical armor required to reinforce that perimeter. This armor consists of strict documentation, incredibly detailed record-keeping, and undeniable receipts. You could have an expense that is perfectly ordinary and entirely necessary, but if you cannot produce the receipts, the IRS will rule it completely during an audit. A legitimate business purpose only survives contact with the IRS if it is backed by physical, highly detailed proof. Think back to that nearly bankrupt business owner from the beginning. A strategically protected entrepreneur avoids that fate entirely by preparing their documentation well before the audit letter arrives. You do not have to be perfectly flawless on day one to start implementing these defenses. The required entrepreneurial mindset is about being willing to fail, learning from those mistakes, and rapidly adjusting your structural defenses. Striving every single day for that level of excellence is the relentless pursuit of perfection. Mastering tax compliance serves as a foundational exercise in overarching business excellence, rather than a mere chore to avoid penalties. This kind of tactical discipline drives the core mission at GBC. We are focused on building communities of excellence, one person, one family, and one business at a time, accomplished through rigorous education, training, and premium financial services. If you found value in today's rules of engagement, drop the letter G in the comments right now. To take free online classes, schedule a one-on-one video consultation, or join the team to start building your own protected business, visit GinoBradley.com.